The horrifically sad and destructive blitz of hurricanes on the US Gulf Coast this summer lowered domestic crude oil production and tragically cost many people their lives. Hurricane Harvey and the final bill for reconstruction that Texas will face in the weeks, months and years to come is still unclear, but estimates put the economic cost at over $190 billion, making it the single costliest natural disaster in US history. The impact of this season's hurricanes serves to demonstrate the importance of the US in international oil markets and highlights just how far the market has come in the last few years. Therefore, in this video, we're going to take stock of the events of the summer, look at the impact they had and what lessons they can give us about the potential impact of even larger events in the future. This year also serves as a springboard, allowing us to look at the road ahead for US crude and how the US's importance will only continue to grow. The 2017 season has been hyperactive, featuring 17 named storms, tying it with 1936 as the fifth most active season since records began in 1851. The two most impactful for oil, Hurricane Harvey ripping through southern eastern Texas and Hurricane Nate pounding Louisiana, Mississippi and Alabama, dropped US productions to yearly lows. In fact, at the height of Hurricane Nate, some 95% of offshore crude output was offline. And even days after passing through, Nate had shut down more than 1 million barrels per day of production from the Gulf. Ample storage elsewhere in the US meant that the temporary shutting off of production did not lead to significant shortages across the whole country. The main effect domestically was on the supply of refined products on the Gulf Coast, which led to an increase in prices for gasoline, diesel and jet fuel. The impact of that lost million barrels per day production was mitigated by an almost equal fall in consumption, with an estimated 800,000 barrels per day decline in consumption in the first half of September as a direct result of Hurricane Harvey and Hurricane Irma. Whilst the production of shale oil took several weeks longer to recover, despite initial fears, US production as a whole was not greatly affected, and the loss of output from Eagle Ford was offset by gains in US oil production elsewhere. The main effect in the short-term markets of Harvey was in the refined products sector as the US ceased to export products from the Gulf Coast. The significance of the cessation of exports is underlined by the fact that the US Gulf is the world's largest exporting region for refined products, with more than half of the refinery output of the region being exported, either to other parts of the US or predominantly to the overseas sector. Internationally, the Gulf's main destinations are Latin America and the booming Asian market, which is becoming increasingly important. Closest to home, the single largest buyer of US refined products is Mexico, which obtains half its diesel and gasoline from refineries across the Gulf Coast. But the US is an important supplier of refined products across Latin America and the Caribbean as a whole. This is likely to remain the case despite renewed fears in some Latin American countries that a high level of dependence on the US for products makes them vulnerable to supply shortages each time a major storm system crosses the US Gulf. There is further disquiet, especially amongst governments, that such shortages lead to price rises in retail markets there. Take the case of Brazil, which saw a 12% rise in domestic prices of liquefied petroleum gas as a direct result of the disruption of US exports in the wake of Hurricane Harvey. The US is not alone in having significant oil and gas reserves. The problem in many Latin American countries is that they failed to invest in new refining capacity in recent years when demand was rising. Instead, several of them found it cheaper to import US products that had themselves been made cheaper by the rise in production of US shale oil. Undoubtedly, more domestic refinery capacity is the answer in these countries. But the obstacles to this are formidable. Many countries in Latin America have plans for increased capacities, mainly in the form of larger new refineries. But in most cases, these plans have stalled for a number of reasons. Let's be honest, mostly connected with cost. Building new refineries in most parts of Latin America is expensive. There are arduous conditions to be complied with, and the process of approvals for new plants can be both lengthy and costly, which puts off most international oil companies. The state-owned companies, on the other hand, are frequently strapped for cash, in many cases as a result of having to spend heavily on mature and declining oil fields or new and expensive ones to replace them. The result is that most are heavily in debt and, as we looked at in a previous video in the case of Venezuela, cripplingly so. The poor condition of the existing refinery network across Latin America means that throughputs are also remarkably low. Last year, refineries there produced 5.4 million barrels per day, compared with a total capacity of almost 8 million barrels per day, giving a throughput of less than 70%, although, let's be honest, in a number of countries even lower. Oil consumption, meanwhile, is just shy of 9 million barrels per day, leaving a large structural deficit that must be imported, mainly from the US. In an attempt to attract foreign investment into the downstream sector, the Mexican government has allowed foreign oil firms to sell refined products there. A number of companies have announced plans to enter the retail, storage, distribution and import businesses. Most of them are from the US, in a move that can only make Mexico more dependent on imports of US refined products in the short term. In the longer term, however, it's less clear what might happen. President Trump has indicated his wish to renegotiate the terms of the North American Free Trade Agreement, or NAFTA, that covers trading arrangements between Mexico, the US and Canada. The impact of this is yet to be fully seen, but it could make supplying products from Mexico less attractive to US corporations. Venezuela, like Mexico, has had to increase its reliance on the US to make up for the deficit in its own production slate. The degree of Venezuela's future dependence on the US, however, may be determined by politics rather than the state of its refinery industry. If relations between Washington and Caracas continue to deteriorate, and President Trump decides to add further financial sanctions to those already imposed in trade, both refined products and crude oil could eventually be dragged into the growing political spat between the US president and his opposite number in Venezuela. The growing political and commercial risk closer to home, along with the increased demand across the Pacific, has led to Asian imports of US products growing considerably over the last decade. These sales look set to go on rising, though US exports are likely to face growing competition from the new refineries in Asia and the Middle East. The growing importance of US supplies to Asia was evident as soon as Hurricane Harvey made landfall on the Gulf Coast, as gasoline and other prices rose sharply in Singapore, along with basic petrochemicals on fears of the loss of shipments of US naphtha and NGL supplies. Looking further ahead, US gasoline consumption is nearing its peak, and US refiners, who are configured in the main to maximise the production of gasoline, are likely to look to Asia to take much of the future surplus from the US as MoGas is backed out of the domestic market. The Trump administration is encouraging the growth of crude oil exports, for example by making it easier for new pipelines to be built from inland oil fields to the Gulf Coast. US Gulf ports are also planning developments that will allow them to handle the very largest of tankers, thus reducing the cost of shipping to Asia. The long-term effects of these hurricanes are still tough to gauge, but they are surely less than some were claiming at the time. In fact, the oil industry has proven quick to rebound, and some have US crude output surging to 10.2 million barrels per day next year, up from 9.2 million barrels per day this year. Again, it's hard to overstate just how much stronger and more efficient US oil and gas companies have been forced to become in the 3-year downturn in commodity prices. While there's no doubt that Hurricanes Harvey and Irma, amongst others, definitely caused significant disruption in the US's oil and gasoline delivery systems, the reality is those disruptions were rapidly resolved, and the storms really made no long-lasting impact on global oil and gas markets. What conclusions can we draw? Well, 2017 will certainly not be the last year in which US exports of crude and refined products are disrupted by storms, but the market certainly looks able to weather their impact. Whether it's Nietzsche or Kelly Clarkson, what doesn't kill you certainly makes you stronger.